S&P and NASDAQ on pace for their fifth negative session in 6 as earnings season does ramp up. Of course, that Fed meeting just 1 week away. Joining us here at Post 9 this morning, Regions Asset Management CIO Alan McKnight. Regions, of course, $70 billion of client assets under management. It's good to have you back.
Great to be here, Carl.
What do you make of this talk about the perils of a cutting cycle and whether or not de-inversions are dangerous, that kind of thing?
Well, it's interesting that Mike was talking about historical precedents. So if you go back to 1980, what you've seen is that small caps have underperformed coming out of the first cut over multiple scenarios and down almost 7% historically. So again, you can't go back to the same playbook, but I do think maybe the market's gotten a little ahead of itself in terms of this belief that reversal, reallocation of small cap, and chase that in the short run.
Is that another way of saying that if cuts do come, they're probably late?
I think they're probably a little bit on the late side, but not materially so. And I think the reality is they're right in this middle ground where they're trying to determine, okay, is there quite enough? And they want to be more cautious or more conservative. To a certain extent, it reminds us of the sun also rises. How did you go broke? Gradually and then suddenly. You know, and that sudden, okay, the markets are here. They're waiting for it. Is it July? Is it September? We think it's probably September.
Why don't you believe in the rotation into small caps?
Well, we just think that if you look at the earnings profile for small caps right now, and depending on which metric you use in which index, they aren't generating the level of earnings that we're seeing in large cap. So to reallocate to small cap, you'd have to believe, I think, over 24 and 25, they're really going to pick up some momentum in terms of earnings power. We're just not convinced that's necessarily the case. An environment where the economy's slowing, even with Fed rate cuts,
lower
even
interest
with rate
rates.
cuts, unless we get significantly a higher number of cuts than we've anticipated.
So does that mean you lean into whatever strength mega cap tech gives you at this point?
We still lean into it, and I think we talk about it as the crossroads. So if you can meet the numbers, I mean, we see with Alphabet today, very high expectations, unable to meet those expectations, market is punitive to it. But if you can actually hit those numbers, and we've seen it in other names, you're being rewarded. I think the big challenge for the market more broadly is that it's not just revenue growth right now, it's also margin expansion. That's what's fueling the earnings growth this year and the next year. We haven't seen all companies deliver on that.
Because of the pain that at least big tech players took last year.
That's exactly right. That's right. So what's the incremental amount they can really pull forward in terms of expense management, particularly while they're spending so much on the AI front? I mean, you saw that in the Alphabet numbers in terms of $13.2 billion spend. I mean, that's a material number without the associated return yet.
And the other reason people are buying small caps lately is increased odds that former President Trump wins the election again, Republicans get Congress, and we see lower corporate tax rates, which would be a relief and would help earnings.
That's right. And so there are some of those aspects and factors that could certainly improve the landscape for small cap names. I think it's really the challenge for us is determining how much do you assign a probability to that in the short run when there's so much room until the November election. We
have had folks come on air and argue that it's okay to chase CapEx if you're talking old school CapEx,
right.
That there's still a reshoring wave, an infrastructure wave that will, and even among hyperscalers, they need land and energy as just as much as they need software and hardware, right?
That's true. And I think the challenge for all of us is we're trying to replicate what we've seen historically. The spend on AI right now, it's not the same playbook. And I think to see those types of returns, can we get efficiency and productivity? Yes. But I don't think there's a lot of good data out there right now in terms of what that metric looks like and being able to plug that in. If you think about an earnings model for 25, 26, 27, it's a lot more conjecture than it is fact-based.